First of all, thank you so much for coming along this evening. This is a big deal for us, moving down into Invercargill. We've been operating in Invercargill in the rural market for a wee while, and today I think it's our 36th or 37th birthday for Property Brokers. So it started on the 1st of June, I think in 1987 in Palmerston North, and it's grown so much in the last few years. It's quite remarkable, and we're proud to be here. My name is David Faulkner. I'm the head of the property management division for Property Brokers. As you can probably tell, I'm not from New Zealand, though I do have a strong affinity to Southland. I came to Lumsden in 1995 to play rugby, and I had no idea where Lumsden was. And this is the days before Google Street View and maps and whatever and internet. And I got, I'll come to New Zealand and play rugby, so I'm going to do this. You know, I was about 22, 23 years at the time. And I remember going into the local library. You got an atlas out and got a map of New Zealand, and Lumsden's on the map, so I'm thinking, well, that's all right. There must be about 20, 30,000 people who live there. Well, I got a fright of my life when I got it. So you fly in and just, flying over things, there's nothing there. And the first day, I couldn't believe the fact that people had the cars open. I couldn't comprehend this. Anyway, long story short, fell in love with the country and moved back in 2001. And my wife was from Manchester, 3 kids, 2 of them ironically headed back to the UK, one's playing cricket over there. And so I've been involved in property management for about 2 decades. Started at Property Brokers many years ago, fell into property management. It's a fantastic industry. It's challenging, there's no doubt. It can have its moments. A lot of people, when they phone you up, they're not phoning up to say what a great job you do. Something's gone wrong, something's broken. But it's every day is different. And that's what makes it so rewarding for me. Also, we're dealing with people's lives, their livelihoods, their investments, and we're also dealing with people's homes. One of the things that we also deal with is a lot of data. When you're dealing with a real estate company, typical on the real estate market, it's big peaks and troughs, and at the moment it's dipped a wee bit. With property management, it's consistent. So real estate, big transactions, but not many of them. Property management, thousands of small transactions. And so it can be quite predictable to measure how the business is going to perform. And that's one of the reasons, 2 of the reasons I find the industry so fascinating. What we're here for tonight, well, it's basically to welcome our new clients and our family to the Property Brokers family. We've got a fantastic team of property managers who are at the back of the room. Where are they? So we've got Lily over here, who's looking after our IT. Right. We've also live streaming this. We've got people who are watching this live stream, and for those people who are watching live stream, you're able to type in questions. We're going to do Q&A at the end. We've got Lara at the back. Lara was working for us in Boxton, and her husband's transferred down here, so we got really excited when this merger came together, so we thought we can get Lara back into property management. We've got Tracy, who is an absolute gun at the back of the room there. She's young mother and just absolutely nails it. I've never seen someone with so much energy. Mark, our Rose in all the thorns, our male who's dealing with these feisty females. He's at the back of the room there. So, Mark, just give a little wave to know who you are. We've got Wayne as well at the back. Wayne is our team leader, so he's based out of Dunedin, and he looks after our region here. And I head the division. So we've got over 7,000 rentals in New Zealand. I think that makes us the 3rd biggest landlord behind Barbados Thompson and Kayangarora. So you've got your Harcourts, your Ray Wax, they're franchises. We're not. How we run it centrally through our head office in Palmerston North, and then we've got our troops at the coalface. What's today going to be about? What are we talking about today? So hopefully the clicker works. Here we go. So I'm just going to give you a brief talk. So we've got Chris Pedersen down from Chris Pedersen Mortgages. He's come down from Auckland. He was actually up in Whangarei yesterday, so he's done the length and breadth of the country. He does a lot of public speaking engagements. There's a few better people, if any, than Chris Pedersen in the mortgage circuits, and he's also got insurance and just stepped into finance as well, he told me. So quite the entrepreneur. I'll talk about what's happening in the market in terms of rents. Chris will probably be able to expand on the more economics of it, but I'll just show you some graphs and show you what's happening. I'll give some opinion on things that have happened, but also it'll show of hands to start with. Who thinks tenants should be allowed pets? Put your hands up if you think tenants should be allowed pets. I do. I do. Right, so I'll be able to tell you what's happening in that space, because that's quite an emotive field. And Tenancy Tribunal is now starting to make rulings on that. I'd like to come on to that a little bit later on in the piece. Then Chris is just going to, Chris will pull your mind away. He's got graphs, he's got data, he's got information. He goes quick. He goes quick to keep with him, and you'll get a lot out of this evening. But I will not take offence if some of you get a bit hungry. You've got permission to get up and go and get some food. All right, so I'm not going to look at you and go, what are you doing? Just please go and have yourselves food and drinks. The bar is open. It's on us. All right. I've also got to remember do the whole health and safety. Toilets out the back. Feel free to just go out whenever you want to. Please come back. If the fire alarms go off, a member of the staff will come and tell us what to do. There's 2 fire escapes. One here, okay, so just downstairs. The other one far end, and just keep going down to the corridor and make your way out that way. That's the health and safety stuff that we have to go through. Okay. Some of the things that I want to talk about first is Tenancy Tribunal. So what we are seeing, it's quite funny because you see house market slows down, but rents just keep going up. And I've actually been dealing with quite a few clients across the country who are asking for quite large rent increases. And what's happening is that they're coming off these low interest rates onto these high interest rates. Throw into the hat interest deductibility, costs around healthy homes. Healthy homes, in my opinion, has failed to do what it was set out to achieve. I'll explain why later. And it's putting pressure on rents. So this graph that we have here, this Tenancy Tribunal, the Tenancy Services started to look at what was happening in the tribunal, who's making the applications and what for. Now, and they did this, first time they did this was Q1 2020. What happened in Q2 2020? Lockdown. So you've got a big spike here on landlord applications compared to tenant applications. And then all of a sudden it plummets. Why? Well, what they've done, they've stopped the 21 days. So what happens, you can apply for termination if the tenant goes 21 days in arrears. And then they extended that to 60 days. So it basically got rid of the 14-day notice for the duration of, we had the rent freeze. And so you sort of plummet in landlord applications. Interestingly, once it came off, we saw a big increase, but it didn't reach the heights of back then. Until recently, we are starting to see a gradual increase on landlord applications to the Tenancy Tribunal. What surprised me, because I actually thought with strengthening of tenants' rights, and a lot of what this government has done in terms of strengthening tenants' rights, I think the intentions are good. The intentions are good. Right? But I actually thought we would start to see an increase in tenants making applications to the Tenancy Tribunal. We haven't yet, because this is Q1 2023 in the summertime. A lot of the complaints that you get from tenants are typically around maintenance, and as you get into winter, then you start to dealing with more and more disputes. We're seeing more and more healthy homes applications and people using healthy homes as an issue. Now, why do I say it's failed? I still think the quality of housing isn't great, but the issue that we're seeing a number of healthy homes provide. It's like, remember the methamphetamine fight we had? And all of a sudden, everyone became a methamphetamine expert. And what we're seeing at the moment is a number of people, companies who are starting to do healthy homes assessments. The rules are open to interpretation. They're not definitive. And I was talking to a competitor in Palmerston North, who's actually a good friend of mine, and he said he's had 3 assessments done by 3 different companies, and each of those assessments have come back differently. And that makes it very, very challenging for landlords and for property managers. And it's been an absolutely bureaucratical nightmare for property managers having to deal with healthy homes, particularly when we have this tenancy compliance investigation team which has been set up. And they just come walking into your business and say, right, we want to see your database, show us everything for these 10 properties. And we've got to produce it. And it must have happened to property brokers, I would say, close to a dozen times this year. Now, you can download, this is public information that you can get from Tenancy Services. Just type in Google Tenancy Services Tribunal Statistics, and you can download this information. It's all there, and it shows you what the applications are about, what they're for. Now, the first one here is January to March last year. Then I looked at January to March this year. Sorry, I've got it the wrong way around. That's 2022, that's 2023. Now, you've seen here, as I said, explaining to you the big spike in landlord applications. Why? Look at the rent arrears. I don't know how well you can see that, but that, and you certainly can't see it online, but I'll be able to explain it to you. So Q1 last year, 3,000 applications made to the Tenancy Tribunal for rent arrears. That has jumped by about 40%. It's gone up to about 4,400, just under. So we're seeing more applications to the Tenancy Tribunal for landlords who are finding that tenants are falling into arrears. And we are seeing more and more pressure put on tenants through rent increases. So you can see that's Q1. Then you've got the lockdown. It stayed surprisingly relatively low. I don't know why. We can speculate, but I do not know why. But certainly, once we've seen the people coming off these low interest rates, interest deductibility, which I'll tell you now, in my opinion, is just about the worst decision I feel that this government has made in terms of housing, because I don't think it's benefited anybody. You're putting costs onto a landlord, and those costs are just going to get pushed straight onto the tenant. And you've started to see that gradual increase as more and more pressure is being put on tenants with increase of rents. What is happening with rents? Again, this is information. I source this information. This is public information. You can go off and download these reports. This is Auckland versus the rest of New Zealand. So Auckland there's about 600,000 rental properties in New Zealand. Auckland makes up approximately 1/3 of the market. So when you look at, there's two markets in my opinion. You've got Auckland and the rest. Now, Auckland was impacted probably more than most by COVID, because you've got lots of apartments, lots of overseas visitors. COVID comes along, they leave. And we leave an apartment market which is empty. So you have a supply issue. There's an oversupply of property. And so rents haven't really increased. Rents traditionally in New Zealand since 1993, and we've studied this at length, goes up by about 4 or 5% per annum. The only time where it's actually round about this time in the early or the late 90s, where it just flatlined for about 3 to 4 years. But every other time, it's just gradually, it's gone up. And the rest of New Zealand, as you can see, it's gaining with Auckland. Quite interesting. What's even more interesting is when you look at the provinces. Now, this line is Invercargill. This line is where our head office is in Palmerston North. So just use these two as examples. Rents in provincial New Zealand. Now, I think Invercargill's probably still got a bit of a way to go. But rents in New Zealand or in Invercargill and Palmerston North, that gap has closed dramatically. And it continues to close. Again, is this more people moving out to the provinces? Changing back and work remotely? It's more affordable to get into properties, B&B. All types of factors can lead to shortage of rental properties. Auckland hasn't had that shortage. Right? The most demand we see is 3-bedroom. That's the most demand we see in terms of rental properties across New Zealand. Right? Now, what I've got here are trend lines. So you type in what the trend line's got to do. You can see Auckland's
relatively, a little bit above, but relatively close to where the trend line predicts it should be. But look where Invercargill is. It's probably 5 years ahead of where it was structured to go to. Same Palmerston North's even worse. Now, Palmerston North, you see these spikes. Why do you see these spikes? That's university. That's the student market. Student markets, typically, they rent out higher value properties, more movement. So you've got two markets. So Dunedin has two markets. Has the student market and the typical residential market. Now, I like to refer to Christchurch as a city that gets it right and has got it right. And if anyone was moving to New Zealand and then they said, David, where do you reckon they should move to? After Invercargill, I would say that. I would say Christchurch. Here's your earthquake. So rents have gone up around 4 or 5%, and then you've got your earthquake. Then you see this big spike, and then it stops. That's when the rebuild kicks in. You can see it's starting to go again now, but we've had flatline growth on rents in Christchurch for a number of years because they built enough stock. It is a supply-demand issue. I have so many discussions. I've even gone to Renters United meetings. And my God, that's quite, some of them are really good. You can talk to them. Others are kind of fringe far left and feel the state should house everybody. And we need tenant advocate groups. I say that because tenants do need to be protected. And I argue a lot about supply and demand. Funny enough, I was listening to a podcast on the way over here from BBC about Japan. And Japan has all these empty houses because Japan increases its building regulations every 10 years. So you've got to keep investing in the property. But what happens is they just build new ones. So there was a brilliant article by Stephen Joyce, ex-finance minister, just before the pandemic came along, basically arguing about, and remember Labour campaigned in 2017, they were going to fix housing. And Stephen Joyce gave this brilliant article around, let's look at somewhere that gets it right and have a look at what happened. Now, apparently what happened, Jerry Brownlee, who was the earthquake minister at the time, basically said to the council, right, we've got to release all this land which is held for 30 years to be released staggered. So rebuild can start and people can move on. And you break down that data, that shows you from 2002 to 2011, on average, 5.18% increase. Then, post-earthquake to the middle of July, 10.87%. Then, up till April 2021, this slide's a little bit out of date, but it tells the story what I'm trying to say. No rent increase. And then it's levelled out. It's levelled out to where it should be because demand has been met by the supply. They've got the equilibrium right. Healthy homes, as I said before, I've gone grey, I'm 25 years old, I've gone grey because of healthy homes. Dealing with this, it is a bureaucratical nightmare. Again, well-intentioned, but it has failed. Right? We still see poor quality houses that pass. We have a tenancy compliance investigation team that targets property management companies, but hasn't got the resources to go after 50% of the market, which is the private landlord who self-manages. And we still have tenants living in cold, damp homes. I'm not saying that this is the solution, but I think it's better. And I know because I've got contacts in the UK and talk about this. I think we're going to go down a path similar to this, energy performance certification. Now, at the moment, this was introduced in 2018. And what the level is at the moment, so if you grade between F and a G, you cannot rent out your house. You have to improve it. What should happen, really, is that our properties should be measured. The performance should be measured to see if it's healthy, rather than say, do this, do this, do this, do this. I mean, we have energy stickers on fridges, on cars, or whatever. We should have them on housing. And eventually, I think we will. They've changed the law, and it's likely to increase to a C. This comes into effect April 25th for new tenancies, and then 1st of April 2028 for all tenancies. Now, the risk of enforcing standards like this, and I get both sides of the debate, you need to have warm, dry houses. We've got an environmental issue. Now, I don't lie in bed at night worrying about climate change and climate crisis, though I think it's happening. Right? If we go too hard on landlords, they leave. We've seen that, and that drives up rents. Or you get ghost houses because you legally cannot rent them out. Landlords would rather just, I can't be bothered doing this, so I'm just going to let it sit there and be empty. Or they put it under Airbnb, where they can get some income. And they don't have to worry about going to tenancy tribunal. But I think we're going to see a movement, something to like this. Now, a little bit of self-promotion on but we've developed something with Velocity Global, which is a New Zealand first. And we can do it because of our scale. There is there's very few places you can go to understand what market rent is doing. You can look at bond data, but that's a very manual process. You can have a look on TradeMe, you can see what properties are being advertised on TradeMe. What basically Velocity have done, they're able to tap into a property management software company called Palace and extracts all the rent payments of what's going on. Doesn't collect the properties, it's because there's privacy issue, but it tracks all this data. So we've got live what's happening in the market. And what can happen? A property manager will spend a lot of time dealing with the tenants, probably more time talking to tenants than landlords. And typically, some property managers feel bad doing rent increases. We want to take that away, and what we're trying to do is show landlords what's happening with market rents, actually. Right? So, list of properties, and this is being tested on. It isn't ready for launch yet. We're working on it with Velocity, and it's shown us some fascinating results. So, for example, on this particular portfolio, it's given us an estimate that we could be as much as 12% below market rent. What we want to be able to do is give landlords this information showing this is what an automated valuation is showing you, where your rent sits. And this is what the market is doing. It is still the landlord's decision. Now, lots of landlords want to look after the tenants and keep the rents low. Get it. Completely get it. But there's another part of the equation, what we're working on, and it's emissions. I have this theory that high emission properties will be low rent. And we're working with Velocity's partner company, they're called Generate Zero, just launched. And what we're going to try and do is measure the emissions of our property management portfolio. So this is about 7,000 properties. We're going to try and track data. We've got to give them the right data. And then it will give an estimate. And what we're going to aim to do is, again, this is a landlord decision. We're not going to make landlords do this, but we're going to provide tools for landlords to make informed financial decisions. Because at some point in the future, we are going to see legislation that will pass. I mean, we've signed this net zero by 2050. Now, apparently, 85% of the houses we live in today, or 85% of the houses that we are going to be living in 2050, we're living in now. So we're going to see a lot of retrofitting, double glazing, solar panels. All of this will become law over time because we've made this commitment to do this. And what we're going to be able to do is tap into some of the banks and offer green loans. And the theory we have is that the lower emission, the higher the rent, the higher the value of the property. That's property management. That's increasing the value of the asset, giving you a good return. Yeah, you've got to make an investment, but everyone benefits. The tenants benefit because they're in warmer, dry houses. There's less issues with maintenance, and you've got a better performing property. Now to finish off with, before I hand over to Chris. We're seeing some interesting tenancy tribunal cases around pets. Now, typically, and it's quite interesting because if you go to Tenancy Services website, it still says you need to have a pet agreement and you write a clause into your tenancy agreement. So this is a government website telling us one thing. We have seen results coming out of the Tenancy Tribunal where property managers have taken tenants to Tenancy Tribunal to get tenancies ended of and to remove the pets. Tenancy Tribunal, and they've got no pet clauses in the tenancy agreement. Now, adjudicators are starting to make rulings, basically saying there is nothing in the RTA about pets. Now, you cannot, it is illegal to write clauses into tenancy agreements that are not within the boundaries of the Residential Tenancies Act. That's section 137. You can get pinged for it in exemplary damages. Now, what some of these adjudicators have said, right, there's nothing in the RTA about this, so this clause you've got about no pets is not enforceable. Which basically is saying tenants can have pets. But we're seeing it only on a few adjudicators, not all. And I was involved in a tribunal case in Wellington 2 weeks ago, and at the end of it, I plucked up the courage because these adjudicators can be bloody intimidating. They're there looking at the glasses like that, it would make you feel about that big. And I plucked up the courage at the end and said, can I ask you a question? Go on. Do you think this thing about pets? And we got talking. And I could tell that she didn't agree with it. And she says, David, it needs somebody to appeal it. And when it goes to court, it's different from tribunal. Tribunal's adjudication, it's not bound by law. When it goes to you appeal it, goes to your district court, a judge will make a ruling on it, it becomes law. So we'll go watching this space very carefully around pets, because all that tenancy agreements, we ask, obviously, do you want pets? Don't you want pets? I actually think, personally, tenants should be allowed to have pets, but I think it should be written into the RTA. Like with minor changes, the tenant can make minor changes. Landlord can say no, but they must have a valid reason. Same with pets. But what I would say is that the landlord can ask the tenant and make the tenant have insurance. So if there's any damage, I think that's a fair compromise. That's it from me. We're doing Q&A at the end, so if you've got questions, I'm happy to take questions. It gives me great pleasure now to hand over to one of the rock stars of the mortgage brokering industry. Chris Pedersen is one of the most recognised, he writes regular comments in the Property Investor magazine, speaks a lot on the circuits around New Zealand. As I said, he was in Invercargill, he was in Whangarei last night. He's in Invercargill today, so he's a well-travelled man. So big hand, please, for Chris Pedersen. Thank you, David.
I was thinking this wasn't the greatest starting slide to come south from it. Screams Jeffrey a bit, doesn't it? I wasn't actually born in Auckland before start, but they probably like most Aucklanders. I was born in Hamilton. So a quick intro, I suppose, on myself. I've been in property finance for overall about 20 years. Give you that one. I've been in property finance for 20 odd years, running KPM actually 16 years today, set up. And we was working for a non-bank property finance before, so seen the people over that time. It's a fairly different world these days. Back then, we were doing 112% mortgages when I started. So it all sort of changed a bit over the years that I've been doing it. Definitely a little bit harder to get for finance in the last few years. Connection to David, my wife and I owned a property management company for a few years, and he was a mentor, taught us everything that we basically knew. And so been property investing for quite a while and kind of around the general traps. So my business sponsors the Auckland Property Investors Association, and I'm in the New Zealand Property Investment Bag each month, talking on finance questions and interest rates and stuff like that. What I'm going to do tonight is kind of run you through a bit of a, I suppose, story over how we've got to right now over the last few years. So it's been pretty challenging going through COVID. And I think while we mainly want to talk about opportunities tonight, there are a lot of people who are struggling. So it's worth kind of understanding what's happened to kind of basically take us from then to where we are now. Also to make sure if you understand the background to that, you don't fall into the same problems. We are seeing a lot of people on what I call struggle street, but if you understand that there's also kind of opportunity here over here that you can hopefully take some advantage of. So jumping in, I'm going to use a bit of a story. These are real numbers behind the scenes. Obviously names have been changed to protect innocent. And so let's say we've kind of got Joe and Mary. We're going right back to kind of a month before COVID. So they've got a household income of about 110k. And they're sitting there with a personal home, no debt, a couple of rental properties, which have $1 million of debt on those, and they're receiving about $1,000 a week from the rent at that stage. Now, at that stage there, they've got an interest rate of 3.6%. They would like an interest rate of 3.6% right now. Yeah? Sounds a lot better than what we're getting at the moment. Now, this is exactly how the banks would look at the numbers. I'm not talking about how you run your budget. This is basically running through a bank affordability calculator. What I mean by that is if you look at your own budget, that's fine. You should always be doing that. If you jump on basically the bank website, they've got mortgage calculators. Those things don't work, they're broken. They're sales tools that I try and drag you into the branch, basically. And we've got access to the actual tools you need to kind of use behind the scenes. So what we're looking here is effectively the net income after tax, the rental income after they've kind of shaved it down a bit. Then on the expenses side, we've obviously got living expenses for them to live. And you might have noted on the previous slide they were paying an interest rate of 3.6% on an interest-only basis. But banks don't look at that. They use what we call test rates or assessment rates. So if you're taking the debt, they're assessing it basically on whatever the remaining term is, and that's quite important. So if you take your debt out from a 30-year term 10 years ago, you're going to assess it on the residual term of 20 years. They're going to assess it on a much higher interest rate. So we go back pre-COVID, banks were using test rates at around the 6.7% mark. You can see here, total expenses according to the bank is 9,000. So effectively, we've got from a bank point of view, client who's still got a surplus after that, so everything's fine. And we obviously went into a challenging period here where going to COVID, pretty much every economist is basically, predicting that health prices are going to go through the floor. I don't know how it was basically down here, but I know basically leading into COVID, we could tell that the property market was heating up. We had inquiry basically coming in, we had bankers basically apologising because we couldn't do deals around all this kind of stuff. So either we went into COVID, everyone thought the property market was going to crash, I think except for those people who are actually in the game. And suddenly a huge amount of stimulus was put into the market. The official cash rate, which of course is a massive influence on interest rates, was pushed through the floor, the lowest point ever. The Reserve Bank put a huge amount of cash and gave that to the government. Part of the reason also was to drive interest rates down. There were other tools I won't bore you too much with, which were also all designed to continue to push interest rates down and keep them low. We ended up having a situation with the Reserve Bank actually was talking about driving the official cash rate negative. The issue is that none of the banks had the technology to handle it. So they basically had to give them a period of time, and by the time the technology was in place, they realised actually this is getting out of control. We don't have to put that much fuel on fire. So we ended up in a situation, I suppose you've got Joe and Mary.
Just a bit louder, there's people on the line.
We've got Joe and Mary, basically, we're now in early 2021. And at this stage, the property market's really basically busy. There's a lot of activity going on the whole way around the country. And of course, what is also happening is we've had the country lockdown. A lot of people basically can't come into the country. You've got businesses who need to staff up. So basically, income's starting to increase. So Joe and Mary are feeling pretty good at this stage because they've had a pay bump. On the flip side, what's happened with their mortgage debt, interest rates have gone through the floor. So they're sitting there basically with higher incomes, lower mortgage expenses, more money in their back pocket. So what they decide to do is basically maybe look at getting an investment property. We've of course gone through a situation where we've had the stupidity of removing interest deductibility. So we watched overnight. What was happening is probably in our business as an example, prior to March 21, probably 8 out of 10 clients were buying second-hand properties. Overnight, 8 out of 10 were probably buying new build properties, becoming property developers, buying properties off the plan, all this type of stuff, because they were targeting the interest deductibility, if that makes sense. So picking on Joe and Mary here, they've basically bought a property, let's say $500,000, which is going to rent for $400 a week. For those of you who are cash flow investors, it's not a great kind of cash flow return. What was happening is people are going, okay, this is fine, because the money was pretty close to free. Because at the stage here on the new book loans, you could get that money for under 2%. So it was really cheap, so people kind of dived into it. Now, if we go back to the bank calculator, what was happening here, of course, incomes have gone up. The really key thing is the test rate. Remember what I was saying before? Yeah? Has basically come down. and we've got a surplus at the bottom. So the bank said, yes, John Murray, you can borrow some money, go out there and basically buy another property. You're feeling good, growing a portfolio, life's basically good overall. Now, what happened, of course, over the back into 2021 is suddenly we end up with inflation, and that was obviously a big shock. Interest rates have started cranking up aggressively, basically on the back of that. We also ended up with massive lending controls being put in. And effectively what happened is Cameron Baggery, ex-ANZ chief economist, we did a couple of events with him a year, and was talking to him about it. And effectively what happened is you had a whole lot of policy wonks in Wellington who thought they understood finance for what they were trying to do is protect vulnerable borrowers. And he basically found that behind the scenes there was a single person who basically was controlling this and had basically worked in private finance, i.e. a bank or finance company. And so effectively this was MBIE, so Ministry of Business, Innovation and Employment. You should put a P in there for Ministry of Prevention of Business, Innovation and Employment, because that's effectively what they did. Some of you might remember the term CFA, I don't know if it was in the media, not too much down here, but effectively what we ended up with having a situation where it became very, very hard for Joe average good borrowers to get money. So we had a situation, a couple of quick stories. Let's say you had someone who was a first home buyer who was consistently saving $3,000 a month. This sounds like a good character immediately. They've been doing that for 10 months. One of the new rules basically said if they were saving consistently, that had to be taken as an expense. So people were getting declined on their mortgages because their savings were having to get included as an expense when they went for mortgages. Sounds like common sense? Yeah. So this is type of stuff that was happening behind the scenes. We had a situation, I remember a guy as a CEO of a listed company, he's responsible for a balance sheet of well over 100 million. We were having to sit there and go, we're sorry to have to talk to you about like that the banks are concerned because of the rules that have been imposed on them about whether you can manage your personal expenditure. So you're ending up with all of these people overnight who are getting declined on finance. And so what we saw was pretty much that the property market through, the whole way through to the end of 21 was crazy, and it basically got turned off right at the end. And that's because these rules got basically rendered on the 1st of December 21. So we just watched the market basically shut down kind of almost overnight. The market in some ways, that's what we saw, continued on for another 2 or 3 months because people had pre-approval settlements, all this stuff in place. So that continued on basically while they could settle those. And then it kind of, really started to take basically a hit. Interest rates have obviously continued to basically kind of crank up over time. And that's kind of all we almost ended up in this enforced recession. It didn't kind of really need to happen if there'd been some better decision making behind the scenes. So let's say we go back to Joe and Mary, and we're now kind of in the middle of last year. So let's say basically smack on 12 months ago. What's happened is, again, because we haven't really come out of the kind of whole lockdown period, they've had another income bump. So that's good news. The bad news is basically what happened is their mortgage basically payments, of course, have gone flying up. So they're feeling a little bit more tight. Now, what they look at is they go, okay, cool, we're actually still fine overall. We want to make sure that we're going to keep maybe our investment debt on an interest-only basis. Now, historically, what happened is you continue to roll your interest-only loans over again and again and again, as long as basically the properties were not too leveraged. Now, what ended up happening in Wellington, one of these policy wonks were again and saying no better, is they decided to put restrictions on it. And so we ended up with the banks going into a situation where they were basically having to put people through applications to prove that they could afford it only. So again, we've got a common sense situation, a lack of common sense situation, where you've got to prove you can afford it, and if you can't afford it, they'll make you pay more. Does that sound like common sense? Okay. So again, let's have a look at bank calculations when we fast forward Joe and Mary through mid last year. So effectively, income, of course, is basically bumped up, but the biggest issue is the test rate. The test rate is now 7.6%. So now what's basically happening is they're running a deficit. So Joe and Mary have basically kind of moved forward. They've tried to roll that interest-only period, and what's happened is interest-only is now getting forced on principal and interest. What direction do payments go when you go from IO to principal interest? Okay, so they're already feeling a bit of cash flow pressure. So we started to see a lot of people were feeling pretty tight around this time. So as a quick, I suppose, a couple of examples so you can see actually how much this hurts. Let's say you've got a few investment properties, you're carrying a couple of $1 million of debt, you're on an interest rate basically of 6.5%, and you're on basically 30-year term. If you go from interest only to principal and interest, okay, it's painful, it's a couple of $1,000 a month, but in a lot of cases you might be able to make that work. The people who are getting hurt the most, maybe the people who are basically get rolling interest only periods over, they've started with 30-year term, They're now maybe down to say 15 years. And now have a look basically what happens to the jump in payment. Make sense? So suddenly, common sense is, okay, person's feeling some cash flow pressure, maybe give them some time to settle down and get through the other side. And this is not the bank's fault, by the way, this is the regulator's fault. So people were getting slammed with this stuff overnight, on top of cost of living crises and everything else, seeing changes in interest deductibility, all this type of stuff. So if we quickly kind of look at actually Joe and Mary's situation that we've been running through, this is their situation back when they're feeling good life, probably around mid-21. This is their situation probably kind of roughly about now. They're basically having to make about another $70,000 a year in payments. And so part of the reason I'm showing you this is actually to understand, I suppose, what's happened to people behind the scenes, but it's also, I suppose, I'm going to keep emphasising before you go out there, review your own positions, because some of the stuff still hasn't been sorted behind the scenes. It's slowly going to come through. It's going to basically tip some people over, but you also want to make sure you keep yourself safe before kind of charging out there, because there's going to be some great buying opportunities. So, kind of jumping into this, there are some people, unfortunately, on Straddle Street. You want to be the ones who are basically on Opportunity Ave. If you are, I suppose, starting off on Straddle Street, a few quick points. Review your existing mortgages and have a good look at them. So, run a realistic budget, look at your fixed rate reviews. So, as an example, if you've got your debt stagger coming off at different times, sit there and probably budget on interest rates around 7%. Look at them all, stress test yourself. In regards to interest only, look at your expiry dates and kind of stress test yourself. Then going, okay, if you were to get moved from interest only to principal interest, can you afford the changes? Deductibility changes, we work quite closely with a couple of reasonably chunky property accountants, and they're quite concerned about this. Because I think there's a lot of people who might be able to kind of do their own numbers on the interest only side of things, but they're not kind of completely aware about how this is going to maybe hit over the next 12, 18 months. Hopefully, in my opinion, we have a government change, that stuff gets reversed anyway. But you still need to be aware about it right now. So some things which may help, on the back of all of what I've just said, and I want you to be aware about it in case you've fallen into that, a couple of the banks have been screaming at the regulators behind the scenes. So if I take on ANZ and ASB in particular, they've been sitting there and been exceptionally hard to deal with for a long time. If you had your 5 years basically interest only with ANZ, bad luck, they haven't been wrong. They're finally started having some common sense, and even if you're not meeting the affordability criteria with them, they're rolling it. Okay? So if you weren't getting it before, this has been quite a recent change. Potentially for some of you, if you're wanting to do some investing moving forward, while they're being a bit more relaxed, you might want to take the advantage and get the extension now. Because we've seen this happen before, and we saw this through the lockdown period of COVID, where the regulators have put the rules in, but they'll take them off for a period of time. So this is a time where you might want to review it to get your interest only periods extended when some of the rules aren't being applied as hard as they were basically previously. You might be able to also extend the loan terms out. So going back to the example I showed earlier, where the payments on a 30-year principal and interest term weren't massively different to a 30-year interest only term, you might be able to pull your loan terms basically back out if you've got it down to a stage where you've got quite a short term overall. Okay, so a few predictions, I suppose, from my side. The first one's not a prediction, it's basically happened. So we've seen the Reserve Bank thankfully start to relax the loan-to-value restrictions. Now, the first one, I suppose, is we're seeing on existing stock, so this existing rental properties is going from 60 to 65%. I don't see that as a big game changer. The part that I do think will be positive for the property market is the first-time buyers. So effectively what's happened, it's a little bit wordy, is that the Reserve Bank's basically made it. So previously, the banks were allowed to do 10% of their total lending on mortgages with less than the 20% deposit. The banks really struggle to manage that, so they ended up doing about 5%. That 10% is getting extended to 15%. So the capacity they're going to have probably overall will actually double with what they actually use. So I think you're going to see more first-time buyers come to the market. They're going to have access to more cash. That really provides a good kind of stabilising kind of point to the market. For anyone who basically property traders, I think we'll start to see traders going to come back into the market because they can kind of turn stock around as well. More lending criteria will relax. So I mentioned before triple CFA, which is all the annoying stuff we had basically 18 months ago. If we do have a change in government, Nationals basically said that it was basically put it all and repeal it. So that would immediately kind of mean we hopefully have a bit of common sense kind of coming back to the market. Migration's crazily strong. I don't think anyone expected to see exactly how strong that is. And Tony Alexander, one of our economists, is saying about 100,000 kind of expected to kind of tip into the country. That's a positive, obviously kind of basically pushes, upward pressure on rents, it stabilises property prices, in some ways it probably puts kind of downward wage pressure on wages, which could actually be good for inflation on some sides, but on the other side, I suppose just that many people and could actually push inflation up, and that's a bit of a concern, because there's a lot of commentators, now including our Reserve Bank, were saying interest rates have peaked. On the flip side, that many people coming in, questionable, there might still be a little bit more of a rise towards the end of the year. So this is the official cash rate. So the main tool that the Reserve Bank uses to, I suppose, control interest rates. So effectively, they get together every 6 weeks, look at the kind of state of the economy, and they kind of use this, I suppose, as their main mechanism to drive things. So we can kind of see here, this is basically, I suppose, kind of the key COVID time, when we basically went into COVID and they drove interest rates down to the lowest point ever. You can see here, I suppose, the last time we had a decent recession was the global financial crisis, and the Reserve Bank dropped the OCR 5.75%. So they're pushing that down for a few reasons. By dropping interest rates down, it discourages people from saving, so people are more likely to basically go out and spend, and encourages people to borrow, so then they hopefully go out and it stimulates the economy. On the flip side, look at basically what's happened this time. So we haven't had interest rates go up like this in a generation, basically. So hopefully we're at the top. If we're at the top, that will start to give basically a lot of people confidence that now is starting to be a good time to get back into the market. I do think if you're running your budgeting, to be kind of careful, there might still be a little bit more of a rise towards the end of the year though. So other, I suppose, key point is a change in government would be positive for the property market. A mate of mine, anyone heard of Matthew Gilligan? He's quite a well-known property lawyer in the country. He's an accountant based out of Auckland. He posted this on his blog. For those of you who wanting to know basically which parties are best to look at from a property point of view. And obviously I think it's kind of pretty clear that the parties kind of like National and Act are going to do a lot more there. And obviously the parties basically on the left-hand side of the screen. So they've made it pretty clear in regards to things like the tax deductibility, all that type of stuff. They'll basically look to get rid of that. Act would also potentially, if they can make it work, get rid of things like the ring fencing. So you've already had a couple of commentators come out saying that they think that if basically there's a change in government, they literally could be like from a certain 10% pretty quickly. I think that might be being a bit optimistic, but I'm pretty sure that's through the market, but we'll see how that plays out. So let's say you're on the other side of the street, you're an opportunity app. So a few things there. I'm just going to skim over this. In some ways, it's very similar to basically if you're on Struggle Street. Review. You want to make sure before you go diving out there and taking on debt that you actually understand your position, because your view on the position might be quite different to the bank's kind of view because of all these stupid, like, over-the-top rules that have basically been imposed on them. So have a good look in regards to your existing borrowing, in regards to things like loan terms. In some cases, what we can do is extend your terms back out for 30 years, but then structure part of the debt so you keep paying the same amount. So you pay the mortgages off in the same time, you're not paying any more interest, but you look basically a better borrower to the bank. Releasing properties, what we talk about that. One thing we talk to a lot of people about, I'm sure there'll be people in the room with a lot of equity, and probably some cases you've got all of your borrowing maybe with one bank. Banks are very, very good at grabbing everything. You should be basically kind of setting your portfolios up on the flip side, but you're giving them as little as possible. So often when you get to a stage where maybe your leverage is quite low, try and drop first your home out. Then maybe try and drop an investment property out if you're basically not planning to gear up. At that stage there means if something goes wrong, you can control it. And one of the main reasons for this is a little bit similar to the interest-only situation, is what's happened over the last few years. Is if you sell a property and it's basically cross-secured, what I mean by that is that you've got maybe more than one property with the same bank. What's happened is if you've sold a property, the banks have started putting you through a full application process, and if you can't basically meet the current criteria, just like Joe and Mary couldn't, you'll take the full sale process and apply it to the remaining debt. So what I mean by that is some people have been putting property on the market looking to sell it to get their hands on the cash, getting none of the sale proceeds, and the banks are taking everything. So again, if you basically drop securities out and extend loan terms and do all this type of stuff, you can set yourself up a lot better for moving forward. So a quick little synopsis on how we recommend basically people being set up. Let's say you're starting out there, you've got your family home, and what happens for a lot of people, they go charging off to the bank. This bank makes it very easy, and the bank 100% finances that first rental property, second rental property, and as I said before, they cross-secure basically everything together. Don't recommend doing this at all. So what we have is basically an ebook. Basically, you've got forms there. If you want to have a look at it, we get into a lot more detail than I am tonight. But just, I suppose, a quick couple of slides. Let's say you are starting off a family home worth $500,000, and what you've got is a $200,000 mortgage. What that basically means is that you've got $300,000 equity. But on your personal home, as long as you meet the rest of the criteria, you can leverage to 80% of your home. So 80% is 500, basically being 400. So that means you've got $200,000 equity here. What we're saying is keep your home at basically bank one, bank A, whatever you want to call it. Ideally, if you can avoid it, don't go back to this bank to basically get your rental properties. Then what we're doing is basically going to a different lender, bank 2, bank B, and we're looking to get the maximum borrowing we basically can through them. This way you're split banking, you're not securing basically your properties with the same bank. We're looking to always generally try and load the maximum debt onto the rentals, minimum basically debt on your home. So basically when we go through stages like, for example, today when loan to value rules are relaxing, look to push the debt back on the rental properties, pull the equity back in your home, that gives you more movement to move forward with. So make sure also you split bank new build investments. Anyone know on an investment property what you can buy, what percentage deposit you have to put on a new build? 20, yeah. Do you know the day after, basically, how that's looked at? So let's say you put in a 20% deposit, you can borrow 80%. The problem is the day after, basically it's not a new build property anymore. It's now basically considered to be existing. So you can only borrow 65% on that now. So if you secure that basically into your home, you might think you've only used up a certain amount of equity, but as soon as it's now classified as an existing property, you've used up a whole lot more and you're limiting your borrowing power moving forward. So again, what we're trying to say is basically use the minimum deposit against your home, go to a bank, borrow 80%, then we're not going to go back to that bank because the bank's only going to basically look at that property as you being able to lend 65% on it, because that's the existing rules versus the new one. It'll fund you at 80, but once you've got it, it's not a non-new build property anymore. Does that make sense? So something also we're seeing a huge amount more of is basically non-bank funding. And a lot of people, they get scared when they maybe can't qualify through the banks. But what's happened again is because the bank market's got so regulated, we're having to kind of go back to using maybe kind of more out-of-the-box solutions moving forward. So I mean, the real key factors are equity and income. And if you tick both of those boxes from a bank point of view, that's where we're always going to recommend you go. It's going to be the cheapest financing money. But because of this over-the-top kind of regulation at the moment, more and more people are having to look at other solutions. So this is the non-bank market over the last kind of 20 years. I suppose through just prior to the GFC, there was actually kind of a pretty kind of healthy amount basically put through them. And what then happened with the GFC is that whole market got decimated. If you compare the New Zealand mortgage market here to basically other countries, most other countries have a fair chunk of business which is written outside the banks. We haven't tended to have that because of what happened post GFC. And what's been happening with this over-the-top regulation, we're starting to see this market basically building in. So if you basically find you can't access bank funding, don't immediately just sit there and go, okay, well, I'm basically out of the market. In my opinion, the next kind of 12 months or so is going to be some of the best buying opportunities you'll see. And if you're finding a great deal, don't just kind of give up. There's a very good chance there might be a non-bank solution you can use to get it across the line. So just a couple of actual real deals we're working on in the office at the moment. And I'll kind of run you through these, why they weren't fitting a bank, and basically what we're kind of doing to get these clients across the line. We've got clients basically with 300k combined income. They've got a right chunky property portfolio, 16 million property, with about $3.5 million of debt. Their situation is that their debt was actually on good interest rates. So they weren't wanting to basically have to extend all their terms out, because if they do that, they'll lose the interest rates they're on. So they want to be in a position to buy though. They're experienced, been doing it for 20 years, and they're starting to see deals. So the problem is I'm not going to go through all that. That's the kind of analysis we have to do. Basically, to give a snapshot of basically a part of their portfolio. This is basically the lending they had through ASB Bank. And what you're kind of seeing here is loan amount on the left, the actual interest rate they're basically paying per mortgage split, the loan expiry date. So effectively, they've taken the mortgage out initially. They've only got 9 years remaining on all those splits, which basically means, as an example, on the $40,000 on the top, what the bank's doing is taking $40,000. They're going on a 9-year term, because that's what's remaining. The bank test rate at the moment is 8.75. So according to the bank, they're having to pay $536 through their calculator, but in real life, the client's only paying $172. Does that make sense? This is exactly how banks basically work assessing that. So for this chunk of basically debt, which is ASB, the bank calculator says they're paying 11.5K. In reality, they're paying 3.6. So what happens? We go to a bank. Any bank is going to do this to them, because any of the banks are going to basically run all of them through those residual terms, high test rates, etc. And these clients, as strong as they are, have basically a negative $7,000 a month basically loss. But basically, some of the non-bank lenders, what they'll allow us to do is work off actual payments. So suddenly, we're using the number on the bottom right rather than 11,500. So suddenly, bank can't get money, non-bank money, easy to get money, these guys are in the market. Now, we're not talking long-term non-bank clients. These guys are far too strong to basically stay a non-bank for long. We're going to play the game of getting them there, and effectively, when they're going to come off some interest rates in the future, we can then extend terms back out and take them back to the bank. Does that make sense? So we're using an advantage of, we've got a market at the moment with some great deals around. They're better to keep the majority of the debt as it is and hang on to the good bank interest rates. Pay a little bit more through a basically non-bank. We give them an interest rate of 8% here, and then we'll sort them out probably in 12 months' time or something like that. But this is another, I suppose, more interesting one. This particular client has found a good deal for 900K. The property requires 100K renovation. After renovation, value is actually 1.3. The client has access to 290,000 through year equity, and bank funding requirement, as per last week, was 460. So they're short in equity. So just looking at the numbers here, from a bank point of view, $900,000 purchase price. They were needing 40%, so 40% of 900,000 is 360, plus the 100,000 renovation fund means they would need 460,000. They've only got 290K there short, so they're out. We've then got two non-bank funders who can basically get in with the client only needing to put 20% in, or if you look at the deposit requirement, 180. So the 180 plus the 100 renovation fund, the client can do that through the non-banks. So we're going, okay, we can't bank fund them. That's obviously what we'll look at first. We can non-bank fund them, so let's keep looking there. So we look at basically both the non-bank options, and obviously you look at the higher interest rates here. This client's got a few other things going on as well. The first one basically had a first mortgage rate of 11.24%. The second one was a combo loan. We could get a 70% mortgage at an interest rate in the 8s, and then 10% to make up the rest at a much higher interest rate, around the mid-15s. Now, some people get scared when they see that, but from a monthly payment point of view, the second option is actually far cheaper. And again, we're just running through all this basically with the client to see if it fits. Keep in mind that we've recommended that. So how are we funding it? They're starting with a 900K purchase price. The market value, the value of basically found at the purchase price, so in my opinion, valued at kind of what it was probably worth at 920. So there's a pretty pathetic discount on paper at purchase one. What we're doing is the client's basically tipping in the 180K plus 100,000 renovation, plus the cost of 720 we're getting from the non-bank, so we've got $1 million in it. And then what we've effectively got is a property which is basically worth 1.3, and we've got basically 23% discount there. And what we're looking at, I suppose this is the key part to also understand, we've got a property of completion with 1.3, we've only got 720K debt on it, and as per basically the rule change now, you can lend up to 65% on the property, so 845K. So what we're doing is we're stepping the client through, and we're just going to refinance it back to the bank. So yes, there's a bit more expense while we get there, but as you can see, the client's making a circa 300K equity because of where we are in the market, and we end up with a pretty good result. We like that result overall. It's pretty good overall. So I thought that's pretty much what I'll run through, and then we'll go through some questions or bring David back on. If anyone who wants to probably know anything more, I'm actually doing a webinar with Jared Kerr, who's the Curve Chief Economist, Wednesday next week. So for those of you who probably want to kind of keep on top of kind of interest rates, where he thinks maybe the market might be going, I find Jared pretty good. Starting up like kind of Tony Alexander and Cameron, I find Tony can be a little bit bullish at times. Cameron can maybe be a bit negative. I find Jared's pretty good overall. So basically that's free to attend if you're interested at all. Basically, just let that form again. We can get on it as well.
Where's Cameron from?
Oh, say it's Central Otago somewhere. Yeah, I'm not sure exactly where it's born.
Ladies and gentlemen, what do you reckon? Go. Yeah. So we've got our roving reporter over here, Wayne Thompson with the microphone. If you've got a question that you want to ask, stick your hand up, either myself or Chris, just far away. And anybody online who wants to ask any questions, just type in your question, and the fantastic Lily will read them out and we'll go for it.
Any questions?
I will go back. Anyway, listen, we're going to stick around for a drink. So if you want to talk with myself, Chris, or any of the property brokers family, feel free to do so. It's been great that you've all come along in the midweek night, and we hope that you've got something out of this evening. Look, one of the things that we have in our logo, we're proud to be here. We're proudly provincial. We'll never go into Auckland. We leave that to bar huts. And, you know, we're here for the good of the country. We're proud of our communities. We work hard in our communities. We'll do the same in Invercargill, and we give a lot back. And we're just, for the people of here and clients, thank you so much for entrusting property brokers to manage your assets, and for our future clients and people who come along just for out of interest. Thanks for coming along, and we really appreciate it. You've got information on Chris Medicine. Will it be able to access the slides, or you know? Yeah. So if you need to access any of the slides, I'm sure that we'll, you know, just
I want to say, if you want to understand how you look to the banks, we can kind of run you through that a bit. So if you want to have an understanding in regards to how you're looked at, we can kind of show this on.
Thanks for coming along, guys. Hope you've had a good evening, and we'll see you again soon.
Thank you.
Sorry, mate.
Thank you, David and Chris. Thank you both for what you presented tonight. It was all good. Obviously, very fulfilling because there was no questions. But to me, being an ex-banker, I felt really good being out of the industry when I listened to that. But for me, it is a tremendous sight to see so many people here this evening looking at our property management in Invercargill. We've been here a month on that side of the property management, and it is good. And now the residential side as well. Our rural side, having been here for about 3 years already, to be fully part and service in Invercargill and Southland, we're proud to be here. It's a really tremendous thing, and part of I manage Otago and Southland, and to be fully serviced across the two provinces in the south for us is a tremendous, I suppose, business opportunity. But dealing with good people is always a good thing in business. And thank you for coming along tonight, and all the best with your purchases and real estate in the future. And if you have any questions around that property management, don't hesitate to give us a bell. Thank you very much.